All right, all you future CAs, welcome. We are diving headfirst into a super important standard today, AS2, the Valuation of Inventories. We're going to do a quick, super focused revision to make sure you can crush any question that comes your way on this topic. Let's get right into it. So let's start with a question. I want you to really think about this because this isn't just theory. This is a classic ICAI exam trap. They absolutely love testing this, and honestly, a ton of students get it wrong by just netting everything together. By the time we're done here, you'll know exactly why that's a mistake and how to get it right every single time. You know, at the end of the day, AS2 is here to solve a real problem. Imagine a company with a warehouse full of stuff. How do they put a number on it? That number, the value of their closing stock, directly hits their profit for the year. If they get it wrong, they could be misleading everyone. And for you guys, getting it wrong means losing some really easy marks. So yeah, we're going to master this. All right, section 1. Let's get straight to the heart of AS2. Seriously, if you forget everything else, just remember this one thing. This is the foundation that the entire standard is built on. Once this clicks, everything else will make so much more sense. So, first things first, what even is inventory? Well, it's not just the finished stuff sitting on a shelf waiting to be sold. It's the whole production line. It's the raw materials that just came in the door, the half-finished products on the factory floor, we call that work in progress, and of course, the final goods. It's the whole shebang.
Okay, now pay attention because this is a gold mine for MCQs. Knowing what's not covered by AS2 is just as important as knowing what is. The ICAI loves to throw these into questions. For instance, a building being constructed isn't inventory under AS2. It's got its own standard, AS7. Shares you hold for trading? Nope, not covered. Just keep this list in mind. It's a quick way to score.
And here it is, the big one, the golden rule of AS2. I want you to tattoo this on your brain. Inventory is valued at cost or net realizable value, whichever is lower. This all comes down to a core accounting principle called prudence. It basically means don't count your profits before they're earned, but do account for losses as soon as you see them coming. So if your inventory isn't worth what you paid for it anymore, you have to recognize that loss now.
Look at this flowchart. This is basically the entire standard in one picture. On one side, you have all the things that go into calculating cost. On the other side, you figure out the NRV. And at the end, your valuation is simply the lower of those two numbers. Think of this as your roadmap for every single inventory problem you'll ever face.
So we're moving on to section 2. The lower of rule sounds pretty simple, right? But here's where it gets tricky and where the examiner will really test your understanding. What exactly is the cost? Let's break it down so you don't get caught out. Okay, AS2 splits cost into 3 main buckets. First up is the cost of purchase. This is the price you paid, plus any taxes you can't get back, plus shipping to get it to your door, and then you subtract any trade discounts. Second is the cost of conversion. That's the labor and factory costs to turn it into something. And finally, you have other costs, which is basically anything else you spent to get the inventory ready and where it needs to be.
Now, let's zoom in on those conversion costs. The direct labor part is easy. Variable overheads, they're also pretty straightforward. But fixed overheads, this is where the marks are won and lost. This is a favorite area for ICAI adjustments, and there's a special rule you absolutely have to know. Okay, exam trap alert. Listen up. When you're allocating fixed overheads, you don't always use the actual number of units you produced. Instead, you use what's called normal capacity. Think of this as the average production you'd expect to achieve over a few years under normal circumstances. It's a really important distinction.
So what happens if you have a slow year and your actual production is less than your normal capacity? Well, you still calculate your overhead rate using the normal capacity as the denominator. This means some of your fixed overheads won't get attached to any products. We call this unabsorbed overhead, and it goes straight to the profit and loss account as an expense. You are not allowed to hide your factory's inefficiency by inflating the value of your inventory. Now let's flip it. What if you have an amazing year and you produce more than your normal capacity? In this one scenario, you switch things up. You use your higher actual production number to calculate the rate. This brings the rate down and makes sure that you're not assigning more cost to the inventory than you actually incurred. It's a rule to prevent overvaluation. All right, section 3. We've talked a lot about what goes into the cost. Now for the easy part, what gets kicked out? Just memorizing this list can save you from making some really common mistakes.
This list is so important. Any abnormal waste, say a machine malfunctioned and ruined a batch of product,
That's an expense for the period. It's not a cost of the good inventory. Notice the word abnormal. A certain level of normal wastage is actually part of the cost. Storage costs for your finished goods, your office admin salaries, your advertising budget, all of these are period costs. They hit the P&L directly. They do not get added to the value of your inventory. Okay, section 4. We've got the golden rule down. We know how to calculate the cost. Now it's time for the rubber to meet the road. Let's see how we actually assign these costs to the stuff we have left and put it all together.
So how do you figure out the cost of the items left in your warehouse when they're all identical? You use a formula. AS2 lets you use either FIFO, first in, first out, or weighted average. You just have to pick one and stick with it. Now, if your items are unique, like custom-made jewelry or something, then you use what's called the specific identification method, where you track the exact cost of each individual piece. And here we are, full circle, back to the question I asked at the very beginning. This one sentence is the answer. It's the whole ballgame. The standard is crystal clear. You have to compare cost and NRV for each and every item individually. You can't just group them all together. This table shows it perfectly. Look at item A. Cost is 40, NRV is 28. We take the lower one, 28. Now look at item C. Cost is 16, NRV is 24. We take the lower one, 16. You cannot, I repeat, you cannot use that extra 8 of NRV on item C to make up for the loss on item A. The big mistake people make is they look at the totals, cost of 88, NRV of 84, and they pick 84. That is wrong. The correct value is when you add up the lower of column, which gives you 76. Getting this right is a guaranteed way to save yourself some serious marks. We are on the home stretch. Last section. We're going to look at one more special case that ICI really likes to test, raw materials, and then we will quickly cover the disclosures you need to finish the job. So here's a fun little puzzle for you. Let's say the market price for your raw materials has dropped. Your first instinct would be to write down their value, right? Well, according to AS2, not so fast. There's a catch. Here's how it works. You have to look at the finished product that you're going to make with those raw materials. If that finished product is still expected to sell at a profit, meaning at or above its cost, then you don't write down the raw materials, even if their price has fallen. The logic is you're still going to recover their cost when you sell the final product. The only time you write down the raw materials is if the finished product they go into is also expected to be sold at a loss. Then you value them at their new, lower replacement cost. And finally, to make sure you get every single mark available, don't forget the disclosures. It's simple stuff, but it's required. You have to state your accounting policy, which cost formula you used. You have to show the total value of your inventory, and you have to break that total down into the different categories: raw materials, WIP, finished goods, and so on. It's all about being transparent.